Hello, welcome back. So in today's video, I'll be talking about the six-figure sum that I've invested into all these stocks in my portfolio. So for reference, this is my portfolio. So I own a range of companies here, and there's actually a new addition to this portfolio that I'll be talking about later on as well. So the first stock that I'll be covering is my largest position. It is Google. So Google year to date is up around 3%. It is currently trading at 21 times earnings. So what exactly is the Google thesis? First of all, Google is the biggest search engine in the entire world, and it will likely continue this way as well. The company is one of the leaders in AI right now. So you have VO3, you have all the different innovation that the Google team has been coming up with. So the best coding platform, you have Gemini as well, and all the different integrations into all the different portions of the entire Google ecosystem. Google Cloud is also growing rapidly, so it will likely become a larger chunk of Google's entire revenue in the future. And last but not least, ChatGPT may not be as big of a threat as it seemed when it first came out. So when it first came out, Google stock actually dropped by quite a fair bit. It dropped to, I believe, around $138 at that time because of the threat of ChatGPT. But currently, the Google management team has been performing extremely well, and the company is still doing well, producing growth in your Google search portion. So for Google and your browser market share, Google's browser market share has been increasing ever since ChatGPT came out. So despite other alternatives like Safari, like Firefox, even Bing as well, which integrated some form of generative AI into their software, Google is still maintaining its position as the largest browser in the entire world. And besides that, you have Google Cloud that is growing rapidly as well. So Google Cloud currently has around $9 billion of the total $122 billion of net income. And this portion of the business is growing rapidly. So you saw revenue growth of 32% this quarter, and operating income growth of 182% in Q2 of this year. So if we can continue this growth, if Google Cloud can continue growing at let's say 50% over the next 3 to 5 years, then Google Cloud will likely be around 1/3 of the business already. And if you're to add YouTube to that, that will make up to around half of Google's entire net income, which is overall positive for the business, and it is also my thesis for the company. So as long as Google search stays dominant, as long as Google search is able to defend its competitors away and grow modestly, if Google Cloud as well as Google YouTube can outpace Google search growth, then it will take up a larger chunk in the future, making it a lot more substantial in terms of the net income as compared to what it is today. Next, I'll be covering the second largest position, the second largest single stock position in my portfolio, and this company is ASML. So ASML year to date is down around 1%. It is currently trading at a 23 times earnings. So for ASML, it has a monopoly in your EUV segment, and besides that, it also has dominant market share in your DUV segment. So for ASML, their competitors are Nikon as well as Canon. For those two companies, they produce machines that are suitable for more mature chips, whereas for ASML, it is more of the cutting edge ones. So for ASML, it is also riding on the trend of increased litho intensity. So as your chips become more advanced, there'll be more patterns that is needed to be printed on all the chips, which will lead to even more demand for ASML cutting edge machines. And besides that, with AI growth, there'll be more complex chips that will be needed, which means more ASML machines will be needed as well. So we're seeing investments into the US, for example, into fabs. And with the creation of more fabs, it will lead to more machines, and hence more recurring revenue for ASML. And last but not least, the company is also moving away, and it is moving towards more predictable streams of income. So for example, your installed base portion, it used to make up less than 20%. It currently makes up around 23% of the total revenue for ASML. And this portion is actually high margin, recurring revenue, almost 100% retention rate business that will be extremely predictable even during downturns. So for ASML, the company has lost its premium. So despite the company being the highest quality out of all your different semiconductor companies, the company is trading at a similar valuation to its counterparts. So for example, Lam Research trades at 23 times, similar for ASML, similar for TSMC as well. So although I view ASML as the highest quality company of all the three here, including other companies like AMAT as well, ASML trades at a comparable or even a slightly lower valuation as compared to some of your wafer fab equipment companies. So for ASML, the guidance is still intact. So they presented this 2030 guidance based on the demand, based on wafer demand globally. So it doesn't matter if Samsung cuts their demand this year. It doesn't matter if Intel cuts their demand next year as well. It doesn't matter if TSMC reduces the capex growth, because the demand globally will still have to be fulfilled in 2030, and someone has to go and buy ASML machines in order to fulfill this demand. So if you were to take the midpoint estimate in 2030, it is still around an 11% revenue growth for ASML all the way until 2030. And you will likely expect net income growth of upwards of 15% if the company is able to achieve this midpoint estimate here. So for ASML, I view it as a strong company, although the company has downside risk as well because you have a lot of the revenue coming in from China. I view this as a high quality business that I'm willing to hold for a very long time. The next stock that I'll be covering as well is my third largest single stock portfolio holding, and this company is Amazon. So Amazon year to date is down around 1%. It is currently trading at a 33 times earnings. So for Amazon, there are a few things that stand out for the business. First of all, Amazon's infrastructure moat is extremely strong. So the company spent billions and billions and billions of dollars building up all these fulfillment centers over the years, and it is almost impossible for any company to replicate this. Because number one, it takes a lot of cost for someone to do it. Number two, the company probably doesn't have the scale that Amazon has to bring in the cash to build out all these different centers. So for Amazon, besides the infrastructure mode, it also has a self-reinforcing loop. So more people leads to even more people using the app, which will lead to even more people using the app. So this is a feedback loop for Amazon. And also the company is the largest cloud provider in the entire world. So it will likely stand to gain from cloud demand as well. And lastly, the company is improving margins outside of the cloud. So a lot of the different segments actually used to be unprofitable for Amazon, but it has recovered to profitability, and a lot of the margins are actually growing rapidly as well. So for Amazon, if you're to look at the other segments outside of AWS, the online stores revenue actually went up by 10%, which is extremely strong. It signals strong retail growth. The physical stores went up 7%. Third-party sellers, despite the tariffs, went up around 10%. Advertising is a strong one. It went up 22%. So your advertising portion is actually a high margin business for Amazon. And seeing this growth is quite remarkable for the company. And last but not least, it has the subscription portion, which is growing around 11% as well, which is another high margin business for Amazon. So for Amazon outside of AWS, if we can see margin recovery for the other portions of the business, then this company will likely generate a lot of alpha above the markets in the future, especially as the company transitions from growth to profitability. And besides that, there's optionality with Amazon as well. So Amazon has all these different robots. They've been spending a lot of money on R&D, on CapEx as well, and all these different robots could drastically improve their margins over the next few years as well. So for Amazon, besides AWS and besides all the different fantastic businesses that they have, they also have the option of increasing their margins over time as AI progresses and as we develop robots. The next stock that I'll be covering as well is Microsoft. So Microsoft this year has absolutely crushed the market. It is up around 25%. It is currently trading at a 38 times earnings. So for Microsoft, it is basically a bulletproof business. The company is diversified. I view this as one of the buy and hold forever companies. The company has recurring revenue businesses that just keeps bringing in cash every single year. And for the first time in many years, Microsoft actually increased the prices of their Microsoft 365 by 30 to 40%. So that actually led to increased revenue for this portion of the business. And that is the first time that they actually increased the prices since 2012. So for Microsoft, it clearly shows that the company has strong pricing power. And besides that, the retention rate is extremely high. And it is a recurring revenue that comes in every single year as well. So for Microsoft, I view this as one of the strongest company in the entire world. So for me, this is almost a buy and hold forever stock. The next stock that I'll be covering as well is MSCI. So MSCI year to date is down around 8%. It is currently trading at a 36 times earnings. So for MSCI, the business is simple in terms of the index portion. So MSCI index portion is actually a highly recurring revenue business that is extremely predictable as well, with secular growth that is tied to your AUMs. So when you have more asset under management, it will lead to an increase in terms of your asset link fees, which will lead to increase in revenue for MSCI, and they are the king of indexes outside of the US. So MSCI has extremely strong brand name, and your ETF managers, they can't get asset under management unless they link it to the MSCI name, which is the beauty of your MSCI products because it is impossible for all these ETF managers to circumvent them and switch to other indexes. So for MSCI, if you have to look at the assets under management growth, as well as the asset-based fees growth, the asset-based fee growth has been around 15% or so almost every single year, all the way until this year in 2025. and the AUM has gone up by around 19% during this period as well. So when you see more AUMs, when you see more monies coming into the market, it will lead to more growth for MSCI, of course. And MSCI is almost operating as a toll gate business for all the AUM that's coming into all these different ETFs. Besides that, MSCI also has strong run rate growth. So the recurring revenue businesses are actually producing strong growth because the company has pricing power. So the company, before they sign agreements with all these different companies, will bake in some price increases every single year. It's around a mid-single digit increase in prices. And if you're to add on volume as well, the company could easily achieve a 8 to 9% growth almost every single year, which is highly predictable, highly recurring as well. And that's the beauty of MSCI's business. The next company that I'll be covering as well is S&P Global. So S&P Global is your credit rating business. It is one of the largest positions in my portfolio as well. So for S&P Global, it is an extremely simple thesis. The company is a toll gate business. It is operating in a duopoly that will likely not change over the next 50, next 100 years. The company has mostly highly recurring revenue businesses, and there's a debt wall that's coming up in 2028 as well. So when a debt wall comes, you will likely see S&P Global's earnings becoming a lot more elevated than it is today. And the other portion is the lowered interest rate, which could be a tailwind for S&P Global. So over the past few years, the growth in the debt being issued has actually decreased because of your high interest rates. And once your interest rates come down, it will lead to even more debt activity, which will lead to more revenue for S&P Global as well as Moody's as well. And lastly, the company has strong pricing power, so they increase the percentage of the debt that they get from all these companies over time, and it is impossible for any company to switch out of it because they stand to gain a lot more getting their debt rated by S&P Global as compared to another company that no one knows, which will lead to a lot higher interest rates for the debt that is being issued. So for S&P Global, I view this as a high quality business that I will likely hold for a very long time as well. The next company is an interesting one. It is one that I just added. So this company is actually Warrior Met Coal. What they do is they dig coal and then they sell the coal. It's an extremely simple business model. And the thesis for this one is as such. So it is the cheapest coal provider in the US. Your coal prices are depressed right now. And once a mean reversion happens, the likely outcome will be that the earnings will recover to historical levels. They also have a new mine, which is called Blue Creeks, which is opening as well. And once they fully open up that mine and fully process the production, that will likely drive up the production of the coal for this company. So if you're to look at the Blue Creeks update as well, the company is pricing the Blue Creeks, that means the net present value, at around $5.4 billion. So if you're to compare that to the market cap today, which is around $2.7 to $2.8 billion, there is around a 50% discount as compared to the actual net present value of this portion of the business. So for Warrior Met Coal, if we ever see a reversion to the mean, which will eventually come, you will likely see this company returning massive amounts of money to its shareholders through dividends as well. And that's why I allocated a small portion of my portfolio in this company. The last two stocks that I'll be covering today are Visa as well as Mastercard. So Visa and Mastercard, they're basically toll gate businesses. What they do every single year is they just stand there and then people transfer them money and they take a bit of money and then they transfer it out. So they're basically a top 5 business in the entire world, and cryptocurrencies will likely not be a risk to Visa and Mastercard because they have the largest network, they have the largest infrastructure in place, and they have the leverage to expand this crypto portion if they want to as well. So for Visa and Mastercard, they're extremely high quality businesses, and I want to increase my allocation in all these companies. But of course, they're trading at quite high valuation today, and that's why I'm staying out for now. Last portion, I'll be covering some questions left in the comments. So the first one, it says, what do you think about Lilu and his portfolio? Like Bank of America, Alphabet, Berkshire, and this other company called EWBC. So for Lilu, if you're to look at his portfolio, I think his portfolio is incredible. It is incredibly concentrated, which is what I like. And this is the type of activity that I would like to mimic as well. So for Lilu, he is an investor that I really respect. And his portfolio shows as well. I mean, his performance has been quite decent ever since he started this fund. And out of all the stocks here, I think my favorite will be Google. Next one will be Berkshire. And then they have this other company as well, which is Sable Offshore. It's an interesting company. For Sable Offshore, they're currently having some sort of a dispute. And once that dispute ends, once they can clear all the licenses, you will likely see this company becoming a multi-bagger if it ever happens. But of course, there's a time limit to that as well. So if you're interested, you can go and look up on it. The next comment it says, long-term, FICO, Amazon, and ASML are good investments. I agree with all these three companies, but for Amazon, they're burning a lot of money in terms of the capex, which is quite worrying as well. So if you're to factor in the capex as real cost, the AWS portion is actually not really growing if you're to factor in the capex. So in the future, if the returns don't come, all this capex will come back to hurt the company, which is a risk that you must acknowledge if you're holding Amazon today. I hope you guys have found this one useful and invest safe.